Hello, everyone, and welcome to the Q&A session on March 29th of 2023. It's good to see all you guys, and as more of you guys join in, you can always ask a question in the queue, and I will get to it when I see it, and we'll go from there. First things first, let's kind of just march out on just kind of what's going on in markets in general, and just kind of give us a little bit of a overview of what's going on. And the first thing that we'll get into here is, as you can see, we had a nice little gap up today. That's what kind of all the excitement is. We've got a little bit of macroeconomics coming up. So tomorrow we've got GDP and we've got jobless claims. So we'll talk a little bit more about that right now. I think the big thing that I'm getting from a lot of members, people, just questions in general, shoot, even my neighbors, is hey, we're back in a bull market. And I think it's always kind of interesting when those kinds of things happen because, just on Fed Day right here, right, everyone thought the world was ending. And then just a couple days, just a week prior to that, everyone thought the world was ending because we had a credit crisis, right? Credit crises don't typically just disappear overnight. Historically, they take a while. Banks are, contracting, things like that. We'll talk a little bit more about that too. But basically, just a little overview of kind of things that are going on. In general, it was a pretty strong day, gap up, things like that. That is the S&P. One thing on here that we'll touch base on is the Fed balance sheet. So this is the Fed balance sheet. This is always something that is always really fun to just kind of overlay onto. We'll overlay it onto the SPY. And then I believe I can. Oop, I might have grabbed the wrong one. No. Yep. No, that's versus US dollar. I don't know what that is actually. Let's not do that. Yep, I'm having a total fail here. That should have been plus, and then versus dollar. No, I just need SPY. Nope, that's a. Yep, there we go. ETF. Nope. Well, that's because it's all. There we go. That's what I needed to grab. Voila. Okay. So one thing that's fun here is, in general, let's just delete that. In general, you can see here that the Fed's balance sheet has quite a large impact on assets in general, right? You can see that when the Fed started to reduce their assets, you saw a lot more volatility in stocks. You even saw, I'm not saying that COVID was a part of that, but you just saw a lot of volatility pick up in stocks. And then, of course, as soon as they started expanding their balance sheet again, right, you saw this big lift off, right? And then, of course, we ended up getting COVID on the backside there. So this is something to always kind of keep in mind, is that when the Fed's in two different modes, right? If the Fed is quantitative easing, right? If the Fed is quantitative easing, it's they're putting new money into the system, right? They're printing money. If the Fed is quantitative tightening, they're taking money out of the system. But as you saw here with this little liftoff that we've had over the last couple weeks here on the Fed balance sheet, which, by the way, we get another Fed balance sheet tomorrow. It has been expanding. Now, they said that they're continuing their quantitative tightening activities, but what they did is they had to cover some bridge loans. And then also what's happening is there are banks that are using their discount window. And then they also created a whole new window for banks that had basically bad U.S. debt. So like if you had bonds or quality debt, you could actually give them to the Fed and for what you paid for them, right? For a small fee, right? As a small fee. But they'll give you, like I said, they'll give you the money that you paid for it in cash. So if you're hurting for cash, if there's a run on the bank, anything like that, basically you can liquidate your assets without actually selling them on the open market. What this does is it keeps the selling pressure away from the market, right? If all of that selling pressure would have come into the market, right, we would have seen it, they're starting to liquidate assets. They're starting to liquidate wherever they can go. Risk premiums go through the roof. And that's what we were starting to see for a little bit there a couple days prior. So keep that in mind. Now, one thing that we're going to look at here is back in '08. I just wanted to just kind of go through here because this is probably the single most common question that I get asked, which is, well, yeah, but why didn't the Fed balance sheet, why didn't the Fed balance sheet help '08 so much, right? Well, it does depend on two ways that the Fed is printing money, right? As I said, through here and here, that was quantitative easing, where they're printing money and they're putting new money into the system, right? Whereas this is trying to suck up bad money in the system. Kind of think about it like bad assets, right? They're trying, banks are unloading these bad assets onto the Fed to try to save themselves, right? And that is exactly what happened in '08 right here. And then we started a little bit of quantitative easing. I think halfway through was when we started to doing the bailouts and stuff like that. That kind of came in a little bit midway through here. So there was a little bit of bailout this time around already, right? Now we say that it's, no taxpayer is going to have to pay it, but anytime you take money and you throw it into the system, and that money that would have contracted would have given us some deflation. Instead, you printed money and put it back into existence, which basically stops the deflationary pressures and keeps inflation high, which is just another tax, right? However you want to look at it. It doesn't mean that it's going to create inflation. It's just keeping the status quo with as much inflation that was already out there, basically. So that's kind of what's going on here. That's what happened in '08. That's why the crash continued to happen in '08. By the way, when the Fed or when the banks started to use this discount window really aggressively, we actually saw a rally in stocks as well. I mean, yes, the market was already going down. So if you kind of look to this to current day, let's kind of zoom over here and let's just kind of see what's going on. Is the market going down or is the market going up? Right. Well, so far the market's been kind of going down right here. Right. I was on the same scale. But we're getting a little bit of a rally, right? A little rally down here, but it's really not. If you go from the time that it started to now, right? It's not a lot of rally, right? So, anyways, keep in mind that that's kind of back in the background. Credit crises, historically, there was a COVID credit crisis, right? So if we look at COVID credit crisis, that actually kicked up in the middle, like the very very beginning of COVID. This little speck that we're looking at right here, I can try to zoom in more, but this little speck right here was actually when the credit crisis came in, and then that's why that discount window started to explode, and then finally in the bottom here was when the Fed really kicked it in and said, hey, we're going to print $3 trillion, right? And so boom, there you go. And then eventually we did get a rally. So without some very, 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 very serious printing from the Fed, without maybe some new borrowing from the government, some other type of mass injection of new money coming into the system, we're still in the early stages of the collapse stage, which is that credit crisis. So we'll go from there. Let me make sure. Yep, I knew I was going to. So, by the way, Michelle's not here with me today, so coming back and forth on the questions, let me just come. I'll get to them in just a second as soon as I see them. So let me go through this. What is the USD debasement and how does it differ from types of inflations, goods, assets, relative inflation? Yeah. Oh, man, what a phenomenal question, Jim. Holy crap. So, yeah, US debasement. So like US dollar debasement is where you start to take the value of a currency, right? In this case, the US dollar. If you start to devalue a currency, and then you are devaluing it relative to other currencies. So, say something like the British pound or the euro or anything and everything. So, if you just start printing money, right, you're adding new dollars to the system. That doesn't actually create new value, right? It's not like your GDP is accelerating at the pace that you're printing. So if you're printing beyond your economics growth, your economy growth, right? If you print beyond that, technically you're debasing your currency. Now, if other countries are printing at that same rate, then you're not really debasing it versus other countries. So that's where relative inflation would come into play. So that means that that relative inflation would stay, relatively on par. So that means tradable goods to other countries would actually be still okay. But what it does do is it makes it to where hard assets, say something like real estate, land, right? Particularly land, because land is not very debt driven, right? Not like the housing sector right now. I'm talking specifically land and gold, of course, precious metals, especially things like copper, palladium, just things that we or platinum. Those types of things are what will really accelerate in value. Lithium, right? Just anything that we use, because your currency, you're creating more currency versus what those are. And so, anyways, also, if your economy isn't growing, so say like your population is shrinking, but yet at the same time you're printing more money, that can also create a debasement of the currency. So, anyways, all those types of ways are where you debase a currency. And anytime that happens, most of the time it's relatively favorable for assets, because even stocks, right? Even equities, because you're debasing that currency. So this massive amount of money that they just put into the financial system didn't necessarily it's not like they're adding money to the system. What they're doing is they're just keeping it par value, right? If if SB Bank would have been able to SV Bank would have been able to collapse, and all of those assets would have needed to be sold in order to make depositors whole and all that. That would have put a lot of deflationary pressure onto assets and brought them back down to true value, right? Or closer to true value. And because that didn't happen, what ends up happening is you just basically keep the status quo. It's kind of like, if you imagine, it's kind of like a put, right? If you're gonna print money when things are about to cave, it's like you're putting a put underneath asset prices, and that's exactly what we saw. We should have seen a crash, but we didn't see a crash, and that's because that 300 billion didn't just vanish like asset prices would have reflected that. You ended up having that 300 billion getting injected back in and keeping it steady. So if we start to see other failures or things like that, or as what normally happens in a credit crisis, other banks start to tighten, right? And the reason why they start tightening is because it's getting tight out there, right? There's less money to go around. There's no new money coming in the system. The economy is starting to slow down. Growth is starting to slow down. Those types of things. So, all right. Can Awake and Sleep Well portfolio be back tested for other days of the week? For example, what's the risk reward ratio for if the models were to be evaluated on Thursday, trades executed on close of Friday at the open? Yeah, so I did test it to where there was other days of the week. It didn't really change the results much. It's just that Monday was my chosen day that I ended up making it down to, just because it made more sense for me at the opening of the week. But yeah, it can be traded other days. I actually did delay it by 3 days for what the allocations are, and the system still works fine. It is more of a longer strategy. I wouldn't necessarily go with that with Awake, because Awake is a little bit more aggressive on how fast it changes allocations, but the Sleepwell portfolio can be delayed pretty significantly. Let's see. Would similar risk reward results across all days suggest robustness of the strategy? Yeah, that's exactly right. Yeah, when you start to see that you can change the day, by 2-3 days or 5 days, or you can start to delay it significantly, and you still see solid results. That is exactly what creates a solidity in a strategy. For the intraday calendar trades, how do you put for the intraday calendar trades, how do puts versus call calendars behave differently? What's one edge versus the other on any given day? Yeah, okay. So technically speaking, there is call and put parity on calendars, and call and put parity, or not on calendars, but on options, right? So if you go on the same strike and you grab a call and you grab a put, they should be the same total price, right? One's going to have intrinsic value, one's going to have a lot of extrinsic value, right? It shouldn't matter, right? But what ends up happening is there's a little bit of extra market pressures on some days, right? So like, let's take for instance, like there's a lot of buying pressure that day. If there's a lot of buying pressure that day, then the demands for calls just ever so slightly eke out a little bit higher than puts, right? It's not normally much, and high frequency traders normally arbitrage it anyway, so you can't really grab it as an edge per se. But what it can do is it can help you with like slippage on execution and basic liquidity, right? So we do have puts or calls on our calendar trades, our intraday calendars, if you're part of one of those subscriptions. And yeah, so some days you can jump on a put, some days you can jump on a call. What you'll notice though is if you grab like the other side of it, right? Like let's say we're in the calls and you jump over onto the put side, you'll notice that the price will be dramatically different sometimes. But what'll happen is the actual decay of it will still relatively be the same. And that's because, your puts are a little bit higher elevated as far as value on your next day out, right? Or 2 days out or 3 days out, whichever one we're using. And so it'll typically use that, it'll make that calendar a little bit more expensive because of how the structure of the S&P is. What that also does, kind of throwing this in there too, is if our edge in that calendar isn't necessarily just time decay and it's a little bit of maybe some volatility in it or something like that, if there's a little bit of extra edge in it, going on the put side does typically behoove you because of exactly what I was saying, that extra volatility that you're buying on your long. It actually gets a little bit of pop in it when there's a volatility spike. Let's see. What is up here? What account value can be used with awake before liquidity of the leveraged ETFs becomes an issue? I'm not sure. That's a great question. Hold with me here on that. The reason I'm not sure is because I haven't hit it yet. I know we've thrown 20 million into each one of these ETFs and have really not had much slippage. So I haven't gotten that big. So I'll let you know when I'm there. But for now, it's not an issue. If you start looking at, because those are leveraged ETFs, and I mean, don't get me wrong, like if you're using like an obscure one, like the emerging markets leveraged ETF, that one you'll probably hit a little bit early and you'll take some slippage on that one. But also, it's not like you need to chunk it in like a millisecond, right? If liquidity starts to become an issue, like I said, I really haven't had a problem yet, but if liquidity does start to become an issue when you're buying and selling an ETF, typically at that point you're probably at, let's just call it 100 million. If you're trying to do that in maybe one of one of those ETFs, keep in mind we use SPY, IWM. These things have hundreds of billions of dollars of transactions every day, right? So the liquidity in these things are insane. Not really going to be an issue, but if it ever does become an issue and you feel that the slippage is getting there or something like that, you can always like call your broker and have them parse it in, or you can just parse it in yourself throughout the day, things like that. Like I said, the strategies have been delayed up to 3 days and been just fine. So it shouldn't be an issue at all. The one thing is like UUP, which isn't leveraged. That one you have to do a lot of shares of that one because the share price is pretty low. That'll be one of those things too. So you're just doing a lot of shares. Anyways, you will hit a limit with some of your brokers if you don't have like certain permissions. So always talk to your broker if you're dealing with large sized orders. Like if you're sending in 10,000 shares, that's typically when they're going to be like, hey, dude, you're sending in a lot. They'll probably reject your order or something like that and say call the trade desk. And then you call them, and then you can just up your privilege, right? You can say, hey, no, I'll submit orders of this size electronically. But sometimes they want you to call in your orders. That happens with butterflies too. Typically, if you send in more than, I think, like 100 butterflies, if you're like a stock retail trader at like TD Ameritrade or something like that, they'll flag you or they'll reject it. And then if you just call them, well, at least in my experience, if you just call them and you say, hey, I need higher limits on this, they'll grant it to you. Okay. For intraday calendars, I think I grabbed all those. Another element that I wanted to bring up because this was something that here. So this is coming from the Federal Reserve, right? Fred economic data, right? So this is always something to keep in mind about the next new bull market that we're supposedly having right now. Keep in mind that rallies happen in bull markets. That's normal. It's just how it goes, right? But bull markets are typically not born in the middle of a credit crisis or a credit crunch. So we have tightening monetary policy. Yes, they're easing off of the gas or easing off of the brake just a little bit by not hiking interest rates, and it looks like because the belly of the yield curve is starting to pull down, it looks like the market is going to pull the Fed down, and the Fed will have to react to that and bring interest rates down. But there's still quantitative tightening unless they keep printing and bailing out banks. Then that's just another form of quantitative easing, so watch out for that. So, but as long as that's happening, as long as those elements are happening, that they're still in this kind of tightening mode, and we have inflation coming down, right? And we also have surveys like this, right? The net percentage of domestic banks tightening standards for commercial and industrial loans to small firms. This is basically like they send out a survey to all of these bankers, and they basically say, hey, are you tightening standards or are you letting go of these standards? Or are you like relaxing, right? If they're relaxing, you'll see this below zero. If they're tightening, it's going above zero. Then you can also see kind of like the general rate of change of this. Are more banks tightening or are more banks, or less banks tightening? That's when you can start to see your general bull market start to be born, right? So right now, granted, this is only of Q1 of 2023, right? So we just got this back, right? In Q1 of 2023, it's getting worse, not better, right? So this is a brand new survey that we just got, and it is not pretty, right? Yet again, we're still on the rise. In fact, we're higher than we were right like in the early stages of the dot-com collapse. That's where we are right now. We're also right in the midst of the Q2 2008 levels for tightening banks. We're also right midway to where we were in the middle of the COVID crisis, but yet we don't have the printing going on and the massive we're going to pay for your mortgages and all that kind of stuff. None of that is going on right now. So there's no like quick turn happening. And that's where we are in the credit, debacle, right? Also, you can see here, even in the middle of this recession in 1990, which that one wasn't a terrible recession because there was a lot of, debasement of the currency. But at the same time, there was also a lot of like outright GDP growth in the United States. We have a little bit of that now, so I just want to talk about a small glimmer in here that's going to be positive here, right? Uh, this AI revolution, if it's leveraged right, it can be and most likely will be the internet revolution, right? So just like we had in the internet in the 90s, where all these .com companies popped up and everyone wanted to, a share of these, most likely what's going to happen is there's going to be all these little AI companies that are popping up, right? Little AI, this AI model, that AI model, this AI model, and it's going to be like an investor, frenzy, right? So that's going to be something there. So on the backside of this, right? On the backside, or even soon, maybe at the end of this quarter, right? On the backside of this, when the monetary policy starts to kind of ease off just a little bit and our growth really starts to reaccelerate again at the same time, and then if the dollar is also getting hammered at the same time, we could have a really, really strong frenzy to the upside in equities. Not even necessarily just U.S. equities, emerging market equities. It would be the way out of all of this is growth. Actually, it's the only way to get out of a inflation nightmare is to actually grow out of it. So cool things. That's what we've got going on. Let me go check questions again. Nope, we're doing good. Okay, so that in general is kind of everything that I had prepared to just in generally talk about. I think we knocked through the questions. I think that we've been cranking through everything. If there's any other questions that you guys want to pop up, go ahead and throw them up. If not, I will leave you there. So I'll give you just a second. Oh, there was a question. Oh man, hold on. I really would have liked to tackle it here. Our anyways, our systems that we have, so like the adapt daily system, the adapt intraday system, both of those use like an indicator that is refreshed constantly on our website after you log in. You get access to that after you subscribe and you're with us, and you'll get access to the forum and community and things like that. That thing refreshes very regularly. The Adapt Daily starts to refresh at 9 a.m. Pacific time, and then basically refreshes every minute after that. So you always know that that current environment is what's in tune for that trade. And the question was is different times of the day. The Adapt Daily can be anytime after that 9 a.m. specific or Pacific is pretty much solid as long as the market's open. If and just kind of stick to your time is what I do, right? So I'm not always perfectly consistent, honestly. Sometimes I'll waver by an hour or so. Most of the time I try to hit it at noon Pacific as best as I can, which is about a market before an hour before market closes. But as long as you're pretty consistent around that, some of my results have been better than even like Michelle's, my business partner, and some of them have been a little bit worse. But we're pretty much right there on par with each other. So it's just one of those things that you can change it throughout the day and it not be too big of an issue. It does mean that on a per trade basis, right, one for one, you're going to have some differences, right? Especially the more volatile the market is. So uh, imagine the swings up and down intraday. If you're swinging 50 points a day or maybe 100 points a day, and everything's based off of where the market is at that moment, you're going to be in a pretty dramatically different position sometimes throughout the day. It washes out in the end, but it does inevitably mean that you will get somewhat different results on a per trade basis. But inevitably, it still results in a strong structure because the structure itself is the thing that has the edge, not necessarily the strike of where we put it the trade on that moment, right? It's not that sensitive of a system by any means. If it was, it probably wouldn't be very viable. And the adapt intraday, those that were running with calendars and things like that, those have to be entered very quickly when the market opens. It's within that first minute, and I'd probably say the maximum you can go is within that first 5 minutes. But watch out with even that, right? On some of the 0 and 1 calendars that we get, you definitely want to go early, because even like today, my trade was in for only 7 minutes and I cleared out for a max profit. So sometimes they're quick. Other days I've been in all day long, and I finally got a profit at the end of the day. Or sometimes you just never get the profit that day. It's just how the trading system works. We go for where the edge is, and we do our best to prepare before we get into our trade, and then we let the market do the rest. Okay, so I think I crushed out all those questions. It was awesome as always, guys. Great questions in the queue. Keep them up. Keep them coming. There's no such thing as a dumb question here. Ask the same question 5 billion times and I'll answer it hopefully 5 billion different ways to try to explain myself the right way so that everyone understands it. Anyways, all right, guys, I'll see you next time.